After the Continental, the Anglo-Saxon, Megan Greene is economist at the Economist Intelligence Unit, covers Greece and also Ireland and Germany. American, working out of London. Let's see if Megan confirms all preconceptions. Over to you.
Hi, I'm Megan Greene. As Andrew just said, I cover Greece, Ireland, Germany, and the Euro crisis generally for the Economist Intelligence Unit. And last time I was here in Athens to speak at an Economist conference, the Economist wrote up a summary at the end and called me a Cassandra. And I now know from Andrew's introduction it was probably him. But in any case, to counter this, I wanted to at least start off with some good news. The good news is that there was actually GDP growth in the first quarter of this year, quarter on quarter. GDP grew by 0.8%. And I start off talking about GDP in part because the main point of this whole bailout package for Greece wasn't just to avoid a restructuring of Greek debt. It was also to achieve a restructuring of the Greek economy so that Greece can return to sustainable growth. Do I think we're there yet, just because there's been a quarter of GDP growth? Unfortunately, no. If you look at all the indicators for domestic demand, retail sales contracted for the 11th consecutive month in February. There's record high unemployment of 15.1% in January. Industrial output continued to fall in February. Economic sentiment, both among consumers and businesses, continues to deteriorate. So looking at this headline figure for GDP in the first quarter, I have to assume that it was underpinned by exports. I think that both shipping and tourism have driven this growth. Greece has definitely benefited from unrest in the Middle East in its tourism industry. Looking forward, I think that GDP will contract again this year by around 4%. Will largely stagnate next year, and will grow only weakly in 2013. So there has been GDP growth, but I thought I'd outline some of what we're up against. You can see here that Greece is an outlier on this chart. For weak public finances, the deficit was 10.5% of GDP last year. Public debt was around 140% of GDP. So Greece is really above and beyond most of the rest, except for Ireland, which doesn't even make it on the chart. Ireland's got its own problems with its banking sector. And I think that Greece will probably continue to miss its targets for fiscal consolidation. The government is hoping that the deficit will be reduced to 7.4% of GDP this year. I think it will probably miss this by around 1 percentage point, and that will continue over the next few years. Greece has also lost competitiveness, as Paul just mentioned. This is improving, certainly. But you can see from this chart of average real wages that Greece is really split off from Germany in particular. Greece has also been living on borrowed money for the past decade. And so while the difference in the current account surplus in Germany, for example, and the current account deficit in Greece is starting to fall, it's still pretty significant. Looking at Greece's fiscal solvency, if you consider my assumptions about GDP growth and about interest rates, Greece will have to swing its primary balance by about 12 percentage points this year just to stabilize its public debt levels. That's a massive swing, and I think it's very difficult to envision how Greece could possibly generate the economic growth required to make such a big swing. I've been asked to speak about Greece's progress during a week when the Troika, the EU, the ECB, and the IMF are actually in Athens to do exactly the same. So what do I think they'll say? Well, Mr. Thompson has outlined some of it. But I think that in the past, for the Troika's reviews, they've been largely positive. I think this time they'll have more trouble being positive. Hitherto, the Troika has been able to say that Greece has roughly hit its fiscal targets and has really highlighted this as a success. There have been some revisions in Greece's fiscal data, which has knock-on effects. And like I said before, I think Greece will probably continue to miss its targets for its budget deficit, though not massively. But as Mr. Thompson highlighted, there's a question of structural reform. And here I think the government has been really long on legislation and has legislated a very impressive amount, but has been a bit less long on the implementation of that legislation. And I can highlight two areas. One is pension reform, which I think has a potential for significant backsliding due to opposition, but also in terms of privatization, Greece is expected to raise around 50 billion in privatization revenues by 2015. And this, I think, will be extremely difficult to achieve, least of all because it hasn't raised a single euro yet. So I think that looking forward, Greece will certainly have to accelerate some of the structural reforms. In talking about, In talking about Greece's progress, I wanted to address what I call the Great Greek Out, which just refers to recent discussion in the international media and also among EU leaders, giving different messages that Greece will either restructure its debt or will be leaving the euro. Why are the rumors happening now? I think it's partly because the Troika is currently in Athens, and it's partly out of anticipation of what their report will entail. It's also off the back of a realization that Greece's bailout actually runs dry next year, so Greece is expected to return to the markets, as does Ireland's, actually. And so both Greece and Ireland are supposed to return to the markets, and I don't think that either country possibly could next year. It's hard to see how either country will have instilled confidence in investors. And finally, the ESM is starting to take shape, and it's clear now that the ESM will be senior to private loans made under the ESM will be senior to private creditors, and so I think investors are panicking about that. Will we see a restructuring pre-2013 when the ESM is due to be implemented? And when I say restructuring, I'm also referring to reprofiling. It's all a way of getting about the same thing through different means. EU leaders have made it really clear that any debt restructuring before 2013 would have to be voluntary. And it raises the question in my mind, who would volunteer? It's a lot of banks and the ECB who are holding most of Greek government debt. And I don't think they would volunteer for a debt restructuring if it were to reduce the net present value of the debt. And the only way the net present value of the debt could be maintained would be if investors were convinced that not only is Greece returned to solvency by this action, but that it is also on a path towards sustainable growth so that it won't simply pile up its deficit and debt once again. And I don't think that Greece has made enough progress in its structural reforms to actually achieve this. So I can't imagine enough banks and the ECB volunteering to participate in a debt restructuring or a debt reprofiling for it to be worth it, for it to even make a drop in the bucket. Furthermore, a CDS payout probably wouldn't be triggered by a debt restructuring. So it's even harder to imagine anybody sticking their hand up for this. It would also represent a political about-face. EU leaders only put together the grand bargain in March. It's not that long ago. It would be really difficult to see them admitting a large mistake and saying that actually they're going to have a restructuring now rather than trying to kick the can further down the road. And while I think a debt restructuring in Greece probably wouldn't pose a systemic risk to the European financial system, there is a risk that it could, and I don't think that, politically speaking, EU leaders would really be willing to take this risk. Much more likely, I think, is that when Greece runs out of money, or before Greece runs out of money next year, Greece will get a new bailout package, or it will be rolled into the much larger European Financial Stability Facility, the EFSF, which should have plenty of money left, assuming that Spain does not require a bailout. I think Greece will be fully funded then through mid-2013 when the ESM does actually kick in, and that then there will be an orderly restructuring of Greek debt. Greece should have a primary surplus at this point, crucially, and I think probably a haircut will be imposed on Greek debt of around 45%, which would reduce Greek government debt down to around 95% of GDP, which is still extremely high, and it's below consensus, I think, for the size of a haircut that would be needed on Greek debt. But I'm below consensus in part because of the exposure of Greek banks, Greek pension, and Greek insurance funds to Greek government debt. I can't see the government agreeing to a higher haircut. It would have real impacts on the real Greek economy. To address this question of Greek leaving the euro, which has come up recently, I think leaving the euro ultimately has to be a political decision. So political leaders would have to sit down and weigh out all the benefits and the costs, and they would have to decide that the benefits outweigh the costs, and I just don't see this happening. I think leaving the euro would probably be a disaster for Greece. On the plus side, it would boost Greece's competitiveness. But Greece would have to reissue its own currency, which would depreciate massively. This would lead to an immediate sovereign default. There would be a run on banks. I think bank default would be almost definite. Greece, if it happened now, would still have a primary deficit, so it would be frozen out of the markets when it still needs money just to run its day-to-day business. There would be capital controls imposed, which is no good for business. And furthermore, Greece still wouldn't have implemented all of the structural reforms that are demanded of it under the Memorandum of Understanding. So Greece would have to deal with all of this and would still not have real credible plans for sustainable growth going forward. I just can't imagine any political leader thinking that that long list of costs outweighs the very small benefits. And I think Greece would probably much rather restructure its debt within the euro than outside of it. Thanks.